Welcome to today's deep dive. If you're tuning in right now, you likely have, that intense learner mindset.
Absolutely.
You want to know how global capital actually moves, well beyond the simplistic headlines you just see on the evening news. And today, we are entirely focused on giving you that exact shortcut.
Yeah, we've got a really fascinating stack of 10 technical charts today.
We do, yeah. 10 charts on the Pakistan Stock Exchange, the PSX, and we're specifically looking at late July to early August 2026.
Right, and our mission here isn't to just bombard you with a bunch of dense financial jargon.
No, definitely not.
The goal is to translate these lines, these candlesticks, and these momentum indicators into a gripping real-time story about market psychology.
Exactly. Okay, let's unpack this.
Yeah.
Because we have to start with the ocean before we can start looking at the individual boats, right?
That's a great way to look at it.
So let's look at the broader market index, the KSE 100. Establishing the overall health and maybe the recent trauma of the broader market is going to contextualize everything else we talk about.
Yeah, the broader index is absolutely crucial because it provides the gravitational pull for everything else in the exchange.
Right.
So as of July 31st, 2026, the KSE 100 is sitting right around 176,094.
Okay.
And if you just look at the daily chart, it shows a minor bump, up about 546 points, which is like 0.31%.
Which, that tells you almost nothing in isolation.
Right, exactly. But when you zoom out to the one-year view, you see this staggering 26.33% gain over the past year.
Wow. A 26% gain in a single year for an entire national index is massive.
It really is.
But the 52-week range paints a pretty dramatic story, too.
Yeah.
It's like a climber summiting Everest. They started from a base camp low of about 138,957, and they just sprinted to this towering peak of 191,032.
Yeah, quite a sprint.
But the recent action is what really caught my eye. There's this very sharp, steep drop-off, just plunging from that 191K peak down to the 176K level we were at right now.
It looks violent on a chart, certainly.
Right. It looks terrifying. Is this market just setting up a base camp to catch its breath, or are we looking at an avalanche here?
Well, to understand the true health of the market, we really have to look past the raw price. We need to check the 4-hour chart's RSI, the relative strength index.
Okay, let's do that.
Right now, it's currently sitting at roughly 49.
And just for you listening, if you don't use technical indicators every day, think of the RSI kind of like a tachometer on a car going from 0 to 100.
Exactly.
If the needle is pushing 70 or 80, the engine is revving way too high. The market is overbought. But if it drops down to 20 or 30, it's oversold. People panicked.
Right, and an RSI of 49 is sitting dead in the center. It's completely neutral.
Okay.
The market is neither wildly overbought nor oversold right now. What's fascinating here is that a 26% annual gain absorbs a lot of shock.
I see.
So that steep drop from 191K isn't necessarily a fatal crash. Mechanically speaking, it's a structural reset.
A structural reset.
Yeah, the market is just finding its footing again.
Well, here's where it gets really interesting. If the broader market is just taking a healthy, controlled breather, like you say, shedding points from its 191K peak, which sectors are actually dragging it down?
That is the right question to ask.
Because when we transition into the foundational industrial building blocks, specifically oil and cement, they do not look neutral.
No, they don't. Heavy industries often act as the initial shock absorbers for macroeconomic tightening.
Let's look at the specifics. We have Pakistan State Oil, ticker PSO. It's trading at 337.70, but it is trapped in this really sharp downward channel.
Yeah, a very defined slide.
And its RSI is a weak 40. Then you have DG Cement, ticker DGKC, and it's doing the same thing, just sliding downward to 208.19.
Right, you're seeing a fundamental squeeze there.
But then you have Lucky Cement, ticker LUCK, and it is wild. It's trading around 441.99, but with massive wild price swings.
Yeah, the volatility there is notable.
And what really stood out in the sources was its Stochastic RSI, which measures momentum. It is incredibly low, down at 14. Doesn't all this spell deeper foundational rot for the whole exchange?
I get why it looks that way, but we have to look at what incredibly low momentum actually implies on a chart like LUCK.
Okay, walk me through it.
When a stochastic RSI drops to 14, it implies that the sellers have utterly exhausted themselves.
Oh, interesting.
Yeah, everyone who wanted to dump their shares has already done it. The selling pressure is basically gone.
But the price is still wildly swinging around. If the sellers are exhausted, why isn't it recovering?
Because the buyers haven't stepped up yet. There's no volume.
Right.
So a tiny bit of buying or selling causes these huge swings. But the bigger picture here is that the capital isn't just vanishing into thin air.
So where does it go?
It's rotating. It's rotating out of these capital-intensive heavyweights because institutions know that in a tight economy, heavy manufacturing struggles first.
Got it. So if we've established that money is flowing out of heavy industry, we have to find out where the volatility went.
Exactly. You follow the money.
And that leads us to our wildcard sector, automotive.
Oh, yeah. The auto charts are fascinating right now.
Because they are exhibiting wildly contradictory behavior. Like, let's look at the Gandhara Group. We have Gandhara Automobiles, ticker GAL.
Pure chart chaos.
Literally.
Yeah.
It's trading near 590, but the chart is just full of these massive, violent vertical spikes.
Yeah.
Huge green rockets, huge red crashes.
Whiplash.
But then you look at a deeply related company, Gandhar Tire and Rubber Co., ticker GTYR.
Right. Same supply chain.
Exactly. And it is quietly bleeding out in a steady downward channel, trading at just 32. Its RSI is a sluggish 44, and its Stoch RSI is down at 33.
A completely different picture.
So for you listening, I have to ask the obvious question here. How can the car manufacturer's chart look like the EKG of someone drinking 12 espressos, while the company making the tires looks like a slow leak?
It's a great paradox, but it's a vital lesson in market mechanics.
Let's hear it.
GAL's wild swings, rocketing up to 600 and crashing back down, that likely represents speculative trading.
Ah, so it's not fundamentals.
No, not at all. It's tight supply, day traders, and pure emotional momentum chasing. People see a spike, they get FOMO, they buy in, and then the early buyers dump their shares.
Right, they pull the rug.
Exactly. Conversely, GTYR represents the grounded, sluggish reality of the actual supply chain.
Because you can't really hype up a tire manufacturer the same way.
Precisely. It reflects the real macroeconomic slowdown that we saw in cement and oil.
Right.
I mean, you really have to see how two deeply linked companies can tell entirely different psychological stories on a 4-hour chart.
It's amazing. One is an emotional casino, and the other is just stark industrial reality.
Right.
Okay, so having seen the index correction, the heavy industry slide, and the auto sector's total chaos, we finally need to follow the capital to the market's bright spots.
Yes, who is actually catching the money?
Exactly. Who is actually winning during this KSE 100 cooldown? And our sources point to tech, textiles, and momentum players.
The ones defying gravity.
Yeah. Let's look at Interloop Ltd, ticker ILP. It's a textile giant, and it is actively recovering in this beautifully clear upward channel at 105.3.
And a healthy RSI of 61.
Which is solid. Then we have PAC Telecom, ticker PTC. Quietly but very steadily, consolidating upwards, trading at 72.25.
Very defensive, very steady.
But the momentum star here is TPL Corp, ticker TPL.
Oh.
It is actively gapping up,
Oh.
trading at 20.35 with a really strong RSI of roughly 69.
Which is pushing right up against that overbought threshold, but it just keeps going.
So what does this all mean?
It's the rotation.
Right. While cement crumbles and autos just wildly fluctuate, tech companies like PTC, modern textiles like ILP, and specific corporate players like TPL are soaking up all that displaced money.
Absolutely.
I mean, looking at TPL's chart, it's like watching a surfer riding a perfect wave while everyone else is getting completely pummeled by the KSE 100 breakwater.
That's a perfect analogy. Because an RSI of nearly 70 for TPL, it shows intense, confident buyer enthusiasm.
They just don't care about the broader drop.
They totally ignore the broader KSE 100's recent 15,000-point drop. It really proves the golden rule of investing.
Which is?
It is a market of stocks, not just a stock market.
Yeah. Great.
For you listening, you really have to remember that finding these upward channels like ILP and PTC during a broader market pullback is the hallmark of smart money rotation.
It is. The money doesn't just evaporate, it finds a safer, more productive home.
Exactly.
So, to bring this all together for you listening, we've unpacked how a 26% annual gain for an index can really hide a complex reality underneath.
A lot of moving parts.
Yeah, you have crumbling oil channels, you have chaotic auto spikes, and surging tech momentum all happening at the exact same time.
Under the same headline number.
Right. And understanding this, understanding how this machinery works, empowers you to not panic when you see a red headline about a big index drop. You know how to look under the hood now.
Because the charts perfectly map where the money is moving.
They do.
We can see it fleeing heavy industry and finding refuge in tech and textiles. But there is a catch. Charts don't tell us who is moving it or why.
Ooh, I like where this is going.
It's something to think about. If institutional wealth is quietly abandoning the physical building blocks of the economy, the oil and the cement to hide in telecom and corporate services during this correction,
Yeah.
What global shifts might they be preparing for that the rest of the market hasn't realized yet?
That is a massive question.
Why are they abandoning the physical for the digital so aggressively right now?
Wow. That is a brilliant mystery for you to mull over as you keep exploring these markets on your own. Keep questioning the consensus, keep looking at where the actual momentum is, and thank you so much for joining us on this deep dive. We will catch you next time.